Our market monitor likes healthcare and energy stocks, two sectors he says have underperformed the market for the last 2 to 3 years, but that's apparently about to change. This is his first time joining us on the program. Let's welcome Michael Liss, Senior Portfolio Manager at American Century Investments. Michael, nice to have you with us. Welcome.
Well, good evening. It's great to be here, and thanks for the opportunity to join you on your show.
Excellent. Well, you've given us some very interesting picks, so let's get right to it. The first one is Zimmer Biomet Holdings, obviously in the healthcare sector, but what in particular does this company do, and why do you like it?
Sure. So Zimmer is a manufacturer of artificial hip and knee implants. And the company's got high returns on capital. We think those returns on capital are sustainable because there are high barriers to entry to keep out competitors. The company bought Biomet in June of 2015, and we think they have a great opportunity to take costs out of the system and take already high returns on capital modestly higher from here. Their priority with their free cash flow is to pay down the debt from that acquisition. We think that's the right thing to do. So you've got a company with high returns on capital. We think they're sustainable and a very good valuation, a cheap valuation. So we think it's a good risk reward for our clients.
Let's move on to pick number 2, which couldn't be about as far from artificial hips and knees as you can get, and that would be Total, the big oil, integrated oil company. Tell me why.
Sure, Tyler. So Total is relative to other energy-related companies, it's less cyclical, and it's got a good mix of upstream and downstream businesses. So between 2010 and 2014, the company engaged in a major investment cycle, developing additional oil and gas properties. As those assets continue to come on stream, we think that their volumes will be able to grow in the mid to low single digits the next several years. And so their cash flow from operations should start to accelerate. And since they've hit the peak of their investment cycle, CapEx requirements should fall pretty precipitously from here. So you've got a situation where cash flow from operations is accelerating, CapEx is falling, and it should result in accelerated free cash flow for shareholders. If you combine that with a very good balance sheet, able to withstand the rigors of the energy cycle, and a dividend yield north of 5%, we think it's a pretty good risk reward for our clients.
And finally, Pfizer.
Sure, Sue. So Pfizer has high returns on capital, and we think that they're stable and sustainable because they have a broad variety of branded drug products. The company has a very good pipeline, and they generate a lot of free cash flow, and that free cash flow really allows them to enhance shareholder value through increasing dividends, stock buybacks, and engaging in strategic acquisitions. In addition, they've got a very good balance sheet. And that balance sheet also allows them the optionality to engage in strategic acquisitions to enhance shareholder value. So again, here's a company with high returns on capital that we think are very stable, trading at a very cheap valuation at a dividend yield just north of 4%. We think that's also a pretty good risk reward for our clients.
All right. On that note, Mike, I want to note that you and your team were recently nominated for Morningstar's 2016 Domestic Stock Fund Manager of the Year Award. So congratulations. Thanks for joining us, and have a great weekend.
Thanks, Sue. You too.
Michael Liss.